Welcome to Age Pension, Super and Retirement. I am your host Yvonne, and this podcast is always information only and never personal advice. Today I will be welcoming back Gayle McHugh, who is the Director of Prosperity Planning Partners. Gayle will be answering many questions on superannuation, and today we are beginning with the topic of the history of superannuation and accumulation accounts. Hello, Gayle.
Good morning, everyone. Nice to be here.
Gayle, if we could just start with a brief history of superannuation.
Oh, well, this is an interesting thing because a lot of people think super started in the 90s, and it did for most people. But for other people, particularly if they work for a government agency, so the federal government or New South Wales government, local councils, or in my instance, when I joined the Commonwealth Bank, it was still way back then in 1980, it was a government-owned institution. So for people who work for government organisations, we have always had access to superannuation, but it was known as a defined benefit scheme. They're as rare as hen's teeth now. They literally haven't been offered to members of the workforce since the introduction of Superannuation Guarantee back in 1992.
Thank you so much, Gayle. That's really interesting. And so are the old-fashioned funds all called defined benefit pensions before we come to what we now know as accumulation funds?
They were just always referred to as a defined benefit account because not all of them came with the guarantee of an income stream. They came with a guarantee, for want of a better term, that your final average salary times your accrual multiple would be available and guaranteed by your employer. That does not mean that it was automatically going to be able to be turned into an income stream and that would be paid for by the government. I've recently, within the last 18 months, helped two people who've had defined benefit schemes. One worked for Queensland government as a teacher and one worked for a local government organisation in Queensland. And both of them had defined benefit funds, and all that did was guarantee that their account balance as at the date they finished work was going to be a multiple, which is that defined in each individual one of those defined benefit funds. They have different accrual rates times their final average salary.
That's great, Gayle. Can I just double check? So the defined benefit funds were sometimes paid as a pension and sometimes paid as a lump sum, Gayle?
Correct. So the two clients that I just spoke about, when they retired from the workforce, their monies from the defined benefit fund were actually paid into an accumulation account, and we've used the balance of that accumulation account to create income streams to fund their lifestyle. So now their balance that was previously a multiple of their final average salary, it's now been linked into market-based investments.
That's much clearer for me now. Thank you so much, Gayle. And a general question, why do we have superannuation?
It's effectively a transfer by the government of their liability to pay an age pension for every single person. And it used to be guaranteed that if you had a pulse and still breathing and above the ground, regardless of your assets, the government paid you a pension once you had met your pension age. They changed that back in the early 90s with the introduction of the Superannuation Guarantee, and effectively they started at that same time to income and asset test pension entitlements.
It's so interesting, Gayle. You may have touched on it a moment ago, but if you could explain, when did superannuation become compulsory? And I might also ask, I know now it's 12% of people's wages or on
Correct.
people's wages. Yeah, what did it actually start at and when did it start compulsorily?
It started back in 1992. Paul Keating, as part of the Labor government, helped bring it to being. And effectively it was 3% of the wage. And what happened at the time, it was sold to the public as this 3%, it's not really your money, which is why a lot of people don't have a lot of interest in super. But effectively, it was a pay rise that was actually being put aside for your future that you couldn't spend right now.
And that's interesting, Gail. Can I just clarify? Some people may think that it's part of their wage, but is it in fact on top of their wage?
Absolutely. It is on top of their wage unless they have a contract which is a total cost package. So for the average income earner who is an employee of a company, unless they're in, say, an executive position or a managerial position, they generally have whatever superannuation entitlements paid by the employer on top of their salary. So if I'm going to use for simple terms today, because my brain's not great because I've got a cold. If you earn $100,000, from a simple perspective, your tax will be levied on that $100,000, but your employer will be required to pay an additional $12,000 to a superannuation account on your behalf if they want to be able to claim a tax deduction and if they want to meet their obligations under the Superannuation Guarantee rules.
That is so valuable to understand that, Gail. Now, could you talk for a moment about the value of superannuation?
I see the value of superannuation, and this is my personal opinion because I've had superannuation since I was 17, and I'm happy to tell you I'm 63. And the reason I say this is when I was 17 and I joined the Commonwealth Bank, they shoved a whole pile of papers in front of me and said, here, sign here. And I went, what am I signing? And they told me. And I went, I don't understand. And they said, trust us. And I ended up in a defined benefit fund. And when I left the Commonwealth Bank, I got a redundancy package in 2003. Our accountant was absolutely stunned at the amount of superannuation I had because I'd always put an additional amount into super in pre-tax dollars, and that helped build my superannuation balance. So what would I have been back in 2003? I would have been 41. I had more than the average female has at retirement in my super fund. So I see the value of superannuation as being the capacity to compound money in a tax-effective environment. Yes, I can't use it right now, but I have the capacity to have choices in retirement that people who don't focus on superannuation don't have.
And I love the way you described it and mentioned compounding. Now, we're also going to touch on a few phrases that may be new to some people, and for others it may be just to clarify your understanding. Could I begin, Gail, with what actually is accumulation phase within superannuation?
So accumulation phase is anywhere where you, as the individual, choose to make contributions to your superannuation, or your employer choose to make contributions to superannuation. The earnings on superannuation are concessionally taxed at 15%. Now, I say concessionally taxed. They used to be taxed at a higher rate than 15%. It used to be 30%. I remember paying 30% on some of my super tax years ago. So 15% is the tax rate that's claimed. I say claimed, it's nominated as a tax rate. But if you have a portfolio of Australian shares that brings with that some franking credits, which is prepaid company tax, you can reduce the superannuation's tax payable significantly by taking advantage of those franking credits. I've had some clients over time where the tax rate has been in their self-managed super fund as little as 5.1% because we've used franking credits to drop the tax liability.
That's fascinating, Gail. So the tax rate that you talk about are on the earnings?
Yes, which includes contributions in the form of a salary sacrifice or something that you want to claim a tax deduction for, or an employer contribution, as well as whatever it earns inside of the fund.
Yeah, that's interesting and cool how you mentioned about franking credits. So it's capped, if you like. It can't be more than 15% of your earnings.
Correct.
Great. Now, I've heard this phrase, superannuation guarantee. What does that actually mean?
Well, basically, that's the amount that your employer is guaranteed to pay into your super as that additional contribution. Remember, I said I started at 3%, and over time, it's gradually got up to 12%. It's stuck at around 6% for many years, but it's now 12%. And that's the guaranteed amount that your employer has to put in on your income. Now, the purpose behind that is, as I said, it's like that forced savings for future retirement needs. Because the government are attempting, and this is a great way of doing it, they're saying, employer, you're giving your people a pay rise, but you're not giving them a pay rise, you're putting it into their super. They're going to use that money when they get to retirement stage, as in the employee, to fund their lifestyle. And if they've got more than the government decides is the maximum that you can have as either a single or a member of a couple, then effectively you're not going to be eligible for an age pension or a part age pension.
That's so interesting, Gayle. And if I could just check, the accumulation accounts, when they're taxed, is that invisible, or if people log into their accounts, can they see this?
Well, that depends. And I don't say that to be putting you off, because in some funds where they're unitised funds, the tax liability is built into that and you won't necessarily see it come out. So most industry super funds are known as unitised funds. If you have, say, a wrap, I'm not going to say these are particularly favourites, but people may know these names: BT Panorama, Macquarie Wrap, Hub 24, Net Wealth. They all have cash accounts that all of their transactions go through. And they're just some of the many providers, by the way. I'm not recommending them, but they actually have a cash account, and the cash account clearly shows the tax coming out. And if you have a self-managed super fund like I do, then I actually get a tax bill and they send it to me and I pay it from my self-managed super fund's cash management account to the ATO. So when I say it depends, it really depends on the type of super fund you have.
Fantastic, Gayle. Now, we talked about the Superannuation Guarantee. Could you briefly mention any other contribution types? We will go into detail in future episodes.
Sure. So a lot of people use a salary sacrifice to superannuation. That has to be arranged through your employer. They have to be willing to allow you to do that. And you can basically make contributions to superannuation in pre-tax dollars, which means instead of paying your personal tax rate on whatever your income is, you would pay 15% on the amount that's contributed to superannuation. That, along with that salary sacrifice, if you're allowed to do it, along with your employer contributions, they have a cap of $30,000 per year right now. That's in 2025-26, and that's all you can put in to be concessionally tested at that 15%. That's one type of contribution. However, in our group, as you know, there's a lot of people talking about, I've got a balance of my super and it's less than 500,000, and I want to claim tax deductions for amounts that I haven't already used in previous tax years. So let's say your employer has in previous tax years, because you can go back 5 years, not contributed to the cap. So any unused cap can be used in some instances to manage any tax liabilities that might be arising. Some people use it to help manage capital gains tax. Some people just go, well, I just want to save as much tax as possible. So they salary sacrifice down to as far as they can go without stopping them from having money to live on. And then you could be somebody who's lived in a house for more than 10 years or 10 years or more. And you could be going, oh, this 6-bedroom house is way too big for me. I rattle around in it. I'm going to sell my massive house and buy a 2-bedroom unit, and I've got some spare money. So each person who is a member of a couple can put up to $300,000 into super. So if you're a member of a couple, the couple can get $600,000 into super and you don't pay contributions tax on that. Or as an individual, you can put $300,000 into super and not pay contributions tax on that. And then there's the $120,000 that we are allowed to put in every year, again, based on the 2025-26 tax year. You can put in $120,000 per year, depending upon your age. I've got to be very careful on this, because if you are 74, you can't put $360,000 in, because you can't use the bring forward rule. But if you are younger than that, you can potentially put in up to $360,000 in a given year by using the bring forward rule. Again, no contributions tax. So the reason people have the capacity to put these monies into super, and there's a few if you're a small business owner, which we'll go into later, and that can help offset capital gains tax and things like that on the sale of a business or getting ready for retirement. So from the perspective of why you might want to have super, is the government gives amazing tax concessions on superannuation. So we've talked about accumulation. Once you actually turn it into an income stream right now, again, 2025, 2026, the current tax treatment when you're over 60 for an income stream is a zero tax rate. That means zero tax on the income stream that hits your hands if you are in a funded fund, which is an accumulation account. And the earnings inside of the fund are no longer taxed at 15%, they're a zero tax rate. So that's one of the reasons why people like me consider superannuation to be amazing, because we view it as a tax structure rather than a series of investments.
That's great information, Gayle. And can I just ask, you mentioned briefly 5 years of looking back, I guess, to see if someone had reached their limit of the $30,000 for the concessional amounts. How could someone find out if they had any space to put money that way?
You would have to go into your own individual MyGov account and into the ATO portal, look at your super reporting in there, and that will tell you, because it will tell you your balance as at the previous 30th of June in the previous financial year. So right now, because we're in September 2025, we should be starting to see reporting happening for the 30th of June 2025. It should be starting to appear in the ATO portal very soon. Once you know that your balance is under $500,000, that's the first gate opener for you to be able to make catch-up contributions if you wish to. And that information is available in the ATO portal.
Oh, that's so interesting. And now that you've mentioned this gate opener, I need to dig a little bit further. So if we had just under like 499,000 in superannuation as of the 30th of June, it doesn't matter if it's over 500 when that contribution is made, Gayle?
That's what the rule states. It's based on your balance as at the previous 30th of June.
Well, this is all very, very good information, Gayle. Thank you. Another phrase that some people may or may not be familiar with is the notice of intent. Would you mind explaining to our listeners what that's all about?
Well, I see lots of confusion in the group about this. Why should I have to fill one out? You know, they refused it because they refused it and they won't tell me why. And it's simply because, let's say you have an employer contribution of $12,000 and you decide to put another $18,000 into super as a personal contribution that you want to take a tax deduction for. I'm using deliberately those numbers because they fit in our $30,000 cap this year. Now, if you make that contribution and you go, oh, I've made it, now I want to roll it over and create an income stream, you've actually shot yourself in the foot, because what happens is the fund, when you send that notice of intent to claim a tax deduction, they expect the money to still be in the account which you're giving them the notice for. Monies have to be paid into an accumulation account. And if it's in the accumulation account still, and you want to claim that extra $18,000 as a tax deduction, happy days. They will, provided they still have that $18,000, allow the tax deduction. If they don't have the $18,000 and it's already been rolled over or withdrawn from the account that you are sending the form with the nominated account number on, they can't allow the notice of intent to claim a tax deduction to be processed because they literally do not have the money anymore.
That is really helpful information, Gayle. Thank you. Before we go on to our final question for this episode, Gayle, how could you be contacted?
My email is gayle@prosperityplanning.com.au, or you can give me a quick call on 0407 159 298. And I will return your call if I'm not available straight away.
Wonderful, Gayle. Gayle, I'm curious, how does Centrelink treat your money when it's in an accumulation account?
Now, that depends on your age. And I say that not as a discriminatory thing. It's effectively, Centrelink's rules state that if your money is an accumulation account and you are under age pension eligible age, which at the moment is 67. So let's say I'm 59 or I'm 62 or I'm 64. While my money is in accumulation phase, nobody at Centrelink can count it as part of the asset test. If by some chance I'm under 67 and I choose to create an income stream, I have changed the way Centrelink will now assess my super, because I'm now in payment phase, and payment phase is considered to be an asset. Now, if you're over 67 and your money's still in accumulation phase, they don't care, because you're 67, everything counts from the perspective of age pension assessment.
That's really clear. Thank you so much, Gayle. Remember, this is information only and not personal advice. For our international listeners wishing to join our Facebook group, the code word is orange. Gayle, thank you so much.
You're more than welcome. It's always great to have a chat.